Hello, and welcome to the Certified Equity Professional Exam Overview webinar for Level 3. My name is Pam Chernoff. I am the Curriculum Coordinator here at the CEP Institute. This segment of the webinar is focused on equity plan design, analysis, and administration, and it's provided to help you with your exam preparation process. This Level 3 webinar is being conducted by Christine Zwirling, who is a Senior Manager Equity Operations at Twilio. She's also a member of our Curriculum Committee on the Law Panel. So on Level 3, 29% of your exam will be on equity plan design, analysis, and administration topics. Because it's Level 3, I would expect to see the sort of emphasis on analysis. We're looking for you to be able to pull in different concepts from earlier levels. You're responsible for things that you learned at different levels in addition to things that you'll really be reading for Level 3. So just a couple of notes here. You should definitely read and outline your plan documents and understand them. The XYZ Equity Incentive Plan had some pretty significant updates for 2019. A lot of those were around removing provisions that relied on Section 162M or that were related to Section 162M and that are no longer there. So please do not go into the exam with your equity incentive plan documents from earlier exam administrations, because you may get some things wrong simply because what you have is out of date. The same is not true for the employee stock purchase plan. That was not updated this year, so you could take a 2018 version of that plan and just move it into your 2019 binder. And on that note, I will pass it off to you, Christine.
Thanks, Pam. Just to add on to Pam's study notes, one of the things that I found really helpful for myself, and I always tell people this too, is when you're reading through the plans, try to note the places where they differ from the plans you're administering, because it's super easy when you're reading through these questions, especially the Level 3 questions, and you start thinking about things and you're like, oh, okay, well, no, it's like this, it's like that. And it's like, oh, no, that particular provision is just in our plan. The XYZ plan doesn't require, whatever. So that I think will help you also, so that you're not constantly like, how does XYZ treat this? So anyway, jumping into why we're here, plan design considerations. So first of all, plan design is important. It's important to understand why the plan has or doesn't have certain features. On Level 3, we're concerned about both conceptual framework, what is or is not possible, and ensuring that grant provisions adhere to those plan documents and to regulations outside the plan document. You should expect both theoretical questions and harder questions related to the XYZ plan documents in your binder. The XYZ Equity Incentive Plan has been updated for 2019, as Pam said, and make sure that you do have the current version. So let's talk about stock plan documents and plan provisions a bit. The plan documents set limits. In some cases, those limits are guidelines that protect against vagueness in grant documents. In other cases, they're hard limits on what's allowable under the plan. That kind of limit cannot be overridden by grant documents. Here's an example. A plan has a provision that states, unless otherwise specified, all restricted stock awards shall vest in 4 years, but in no case shall restricted stock awards vest in less than 1 year. The effect of that provision is that the company is free to grant RSAs under the plan that vest in 6 years because the provision allows that discretion. But if somehow an RSA with a 6-month vesting were inadvertently granted under the plan, the rule in that plan document would override the terms of the grant agreement and mean the RSA couldn't actually vest within the 1-year mark until the 1-year mark is hit. The plan document is the superior document. Okay, moving on. Now let's look at a few plan-related topics that newly come into play at Level 3. Here, we're looking at the plan design, administration, and related implications of these topics, not at the legal, tax, or accounting implications. The plan document will specify who has the authority to amend the plan, what approvals must be obtained, excuse me, and publicly traded companies must obtain shareholder approval for material revisions to existing plans. This applies to revisions that expand the scope of the plan, not to the changes not to changes that reduce the scope of the plan. Because of these shareholder approval requirements, pre-IPO companies may choose to amend their plan documents prior to becoming public, in some cases because they'll need to comply with additional regulations after the IPO, and others because shareholder approval can be easier to obtain while the company remains private. The things the company may wish to review before the IPO include plan share reserve. Does the reserve have enough shares to last 1 to 3 years before seeking additional shareholder approval? The eligibility criteria. Excuse me, the administrator should review the eligibility provisions of the plan to ensure they match the company's plan for the future and that they're not too narrow or too broad. Grant types. Does the company want to expand the type of equity that can be granted under the plan? Often pre-IPO companies use only one equity vehicle, while publicly traded company plans usually allow several grant types. Limits on grant size. Capping the amount of equity that can be granted to any individual can be viewed as good corporate governance. Contractual restrictions. Private company plans often contain restrictions on resale of shares, for example, or right of first refusal, allowing the company to buy back shares before they're sold to a third party. These provisions should be removed from the plan prior to the IPO. Exercise payment methods, in contrast, may be expanded at this point. The company may choose to add broker-assisted exercise methods to the plan document if they aren't already there. It should also look at any plan provisions allowing for exercise using promissory note to ensure that method is not available to executives. Plan Administration Committee. Broadly, management should look at the makeup of the Plan Administration Committee to see whether it complies with the conditions of the Exchange Act Rule 16b-3 and the Compensation Committee requirements of the stock exchange on which the company will be listed. These important rules are covered under law, so we won't spend time reviewing those rules here. Okay, now let's look at a couple other plan provisions that come into play at level 3. A publicly traded company that wants to cancel underwater options and replace them with a new grant can only proceed if the plan document specifically allows repricing. If there's no repricing provision in the plan document, both the NYSE and the NASDAQ will regard it as prohibiting repricing. If the plan does allow for repricing, the company must also get shareholder approval before proceeding because the stock exchanges regard the repricing as a material modification. If the plan document includes a limit on the number of shares that may be granted to any one person, both the old grant and the new grant will count toward that limit. Repricing also has legal, tax, and accounting implications, all of which are covered under those topics. As for severance, changes to equity grants at the time of termination must comply with any limits in the plan document. For example, if the plan prohibits extension of an exercise period, that means a longer time to exercise should not be included in a departing employee's severance package. Now, let's look at some outside concerns around plan design. For new equity compensation plans, plan design features are often influenced by how shareholders will react. Some features make a plan more palatable to shareholders, some less palatable. In particular, institutional shareholders often rely on the analysis conducted by proxy advisory firms, Institutional Shareholder Services, or ISS for short, and Glass Lewis. ISS uses what it calls an equity plan scorecard to determine whether it will recommend for or against shareholder approval of a plan. This calculation uses an option pricing model to determine the amount of shareholder equity flowing to plan participants. This shareholder value transfer, or SVT, is expressed in both dollar amount and percentage of market value. In broad terms, ISS assesses plans based on their cost, their features, and the company's grant practices. SVT is calculated two ways and then compared with the SVT of peer companies. One calculation looks broadly at outstanding grants plus the amount requested into the new plan. The other looks at the amount requested for the new plan plus shares remaining for grant under the company's other plans. In general, ISS will recommend in favor of plans whose SVT falls below a company specified cap that ISS does not disclose. although some plan features may prompt a negative recommendation even if the SVT is below the cap. One important aspect of ISS's SVT calculation is how shares in an omnibus plan are counted. Awards, such as restricted stock, are treated as being more than appreciation-based grants like stock options. ISS counts full value awards as more than one share. When ISS calculates SVT, it looks at the maximum possible dilution for the plan, and as a result assumes that all awards will be granted as the most expensive award type unless the plan contains a cap on the number of full value shares that can be granted. As for plans with evergreen provisions, ISS counts the total shares that could become available over the life of the provision as being outstanding. So, for example, if an evergreen provision that provides for 100,000 additional shares to be added to the pool every year for 10 years would have 1 million additional shares added to the SVT calculation up front instead of being added annually when the share pool is increased. Okay, in addition, let me make sure I'm on the right slide here. Sorry, I got me. In addition to calculating SVT, ISS looks at many aspects of a plan. In addition, it does not like the plan features listed on this slide. The first section lists plan features that ISS generally disfavors, but do not necessarily result in a recommendation against the plan. Let's look at a few of these. Single trigger vesting means vesting that occurs upon a change of control without some additional requirement to also be met. For example, termination of employment. Grants that require, for example, both a change in control and termination before vesting are called double trigger awards. Liberal share recycling means returning shares to the share pool in certain circumstances. ISS does not like to see shares tendered to exercise an option, shares withheld to cover taxes, or shares repurchased by the company using exercise proceeds returning to the plan's share pool. Other features listed in the bottom section are likely to trigger a recommendation against the plan with one of these features. A liberal change in control provision is one that would result in a grant vesting without an actual change of control occurring. For example, when shareholders approve a transaction instead of when it is actually consummated, or when roughly 15% or less of the stock changes hands. Likewise, ISS does not like plans that allow option repricing to occur without shareholder approval. It also dislikes plans that plans with certain pay practices it regards as problematic. For example, tax gross-ups to cover excise taxes under Code Section 280G, or a disconnect between pay and performance, which we'll look at on the next slide. In asserting granting practices, ISS wants to see that share usage is reasonable in relation to peer companies and wants to see that a significant portion of the CEO's pay is contributable to performance-based equity compensation. If a significant portion of the CEO's pay is attributable to equity awards that aren't performance-based, ISS considers pay to be misaligned. As a result, ISS will look at any plan offered for shareholder approval in which the CEO is a possible participant and determine 1, the magnitude of the misalignment, 2, the contribution of the non-performance-based equity awards to the CEO's overall pay, and 3, the portion of the equity award granted in the last 3 fiscal years that went to named executive officers. Now, let's switch from plan design to an administrative topic. Administration of performance awards can be complicated, particularly because not all plan designs can be supported by electronic systems. As a result, it's doubly critical that the processes around these plans are organized and well documented. If the company outsources some aspect of the performance award administration, it should expect a high level of involvement in coordinating with the outsourcer that is needed for other plan types. Because vesting is dependent on meeting performance goals and because performance awards may be tracked outside of the stock plan system, clear definition of roles and clear communication between the company and the third-party administrator are critical. In terms of plan administration, tasks around establishing performance goals and assessing progress toward these goals fall squarely on the company. This includes assessing the probability that the goals will be met so that accounting for the grants can be done correctly. If the company outsources all or a part of administration of performance awards, the recording and processing of grants, vesting, and payout may fall to the third-party provider, as may the actual calculation of financial expense, but the expectations about achievement of these goals must still be communicated by the company. And finally, let's look at a few international considerations that come into play at level 3. In addition to concepts around labor laws and data privacy that were introduced in level 2, on level 3, we now look at exchange controls and cultural and language differences. Exchange controls are rules that restrict the flow of money and securities into and out of the country. They vary greatly from country to country. Some countries require conversion either prior approval or subsequent reporting anytime local currency is exchanged in either direction. Currency conversion may require a single approval, or approval may be required for each transaction, depending on the country involved. In some cases, the employee may be required to repatriate funds immediately to the home country, and the transfer may need to go through a designated bank account. There are ways around these restrictions in some countries. For example, in some places, setting grants in cash avoids restrictions. In others, these controls may entirely discourage the use of equity awards. It's always important to address cultural and language differences that may affect whether employees understand and value their grants. Employees inside the U.S. may have at least a very basic understanding of what stock is, how markets work, and a general understanding of stock compensation. This is not always true outside the U.S. Employees may not have a concept of what stock is, or they may understand it but be used to entirely different terminology than what's used in the U.S. Making sure employees understand what they're getting and what it means is especially critical and may include translating plan documents and education materials into local language. And with that, Pam, I'll hand it back to you.
All right, thank you so much, Christine. So for candidates who are interested in additional courses that may help with your exam preparation, we've listed a couple of options on the slide. But I do need to give the disclaimer that this exam overview webinar is provided to assist in your exam preparation, but it's not sufficient exam preparation by itself. We develop all exam questions exclusively based on the textbooks, and you should thoroughly study those materials. So this webinar is available to you for unlimited viewing until the exam date, and the same is true of the webinars for all of the other subject areas and at all 3 levels. So you're welcome to listen to as many of them as you want, as many times as you want. And on that note, thank you again, Christine, and good luck on the test, everyone.